Today I have 10 great trading strategies for you, and we're going to deep dive into supply and demand trading, liquidity trading, price action, trend lines, divergences, and so many other ready-to-use trading strategies. Let's start with some great trading strategies using supply and demand, liquidity, and volume. But what actually makes a supply zone a great supply zone? There are a few rules and qualifiers for finding great supply zones. First, a zone has to lead to a significant trend move, like here we have a very strong breakout and then a strong trending market emerges from that. You want to see a short consolidation before the exit out of the zone. So here we have a very short consolidation. Also, you don't want to see that the consolidation is very deep, so you want to see a very narrow consolidation. We want to see that the initial move out of the zone is very strong. Here we have a very large candle that breaks out of this zone. And ideally, you see that the supply zone is found very early on in a new trend. And you can see we are very close to the top, not absolute top, and that's rarely what you find using supply and demand, but the zone is very close to the top. You can also use a volume profile to find better supply and demand zones, and also it's more of an objective way. So we used the volume profile, I'll show you which one in a moment. And what you'll see is that on the exit out of the supply zone, you have a drop in volume. And the origin of those supply and demand zones are found just before this significant drop-off in volume. And you can see that here's the drop-off when the market broke out of the supply zone, and here this is the actual supply zone. In TradingView, you just open your indicator, you can go to technicals, you click on the profiles, and then you want to use the visible range volume profile. There are a few other volume profiles, you can play around with them, but that's the one I use in this video. I quickly want to say thank you for all of the comments that I see on my YouTube videos. It's great to see this lively community here on YouTube. Unfortunately, I cannot always answer all of the comments. But if you want to get in touch with me and get mentored by me and learn my trading strategies, make sure to check out the link in the video description. I've built a unique trading program where you not only get access to over 80 brand new trading videos, my actual trading strategies, and a lot of trading material with thousands of chart studies, you also have the ability to chat with me 7 days a week. We do have a private community with a chat room in the program, and you can reach out to me every single day, 7 days a week. I answer your questions, I help you analyze charts, and anything else that comes up and that you wonder about when it comes to trading, I'm there to help. So make sure to check the link in the video description to learn more about my unique program, and if you want to get in contact with me, sign up and you'll be ready to go. The way we use supply and demand zones is that we wait typically for the market to come back to the zone. So here you can see that's where the breakout happened, away from the supply zone. It was created here. The market does spend some time away from the zone and eventually comes back. However, what is really important is that you do not trade the zones blindly, which means that just because the market hits the zone, you don't automatically go short. We have to go to a lower time frame. So we go from the 4-hour to the 15-minute. And here we typically look for patterns. We want to look for other signs of weaknesses that the previous uptrend that we are seeing here is over and is rolling over into a downtrend. We can use other tools. This is the daily high and low. I will show you in a later part of this video how to get this on your chart. But what it does is that it plots the high of yesterday's price action on your charts. So this green line here is the high of yesterday's price action. And here you can see the price made fresh highs. So the price traded above the high of yesterday. That's a very strong market, and you don't want to trade a strong market. On the next day, you can see that the green line shifts higher because here is the high of yesterday's price action. That's the high of yesterday's price action. That's the green line. On this next day, we see that the price is not reaching the previous high. So it's a failure to take out highs. The market doesn't come close to the highs, and we see a very tight consolidation here, far away from the highs. That's the sign of weakness we're waiting for. We also see that we have a very good support area. The market breaks below that and now trades lower. That's what we want to see when we talk about weakness in the highs. A lot of traders trade breakouts. So after the market breaks out here below the support level, a lot of traders will get short here. What I have found over the years is that breakouts tend to work less and less often. And let's put us into the shoes of the breakout traders. If you go short here, where do you have your stop loss? You typically have your stop loss a little bit above the support area where the breakout happened. So when the market turns on those breakout traders, they will get squeezed here on the short. This is what we also call a stop run. What you want to then do is on the stop run, we want to look for signs of more weakness. What we can see now is really important. The red line shows yesterday's lowest price point. And what we can see is that whereas previously the market didn't even come close to yesterday's low, now the market is taking out the lows and the market is breaking here into fresh lows. That's exactly what we want to see. After the stop run, the price makes lower highs, and here we have a strong breakout. That's the downtrend confirmation that we have been waiting for. And you can see we don't only trade the supply area is just the hint of where we want to look for a reversal. But then on the lower time frame, that's where we stack all the confluence factors in our favor. We have another short stop squeeze, and then the market rolls over completely. We also have another support level here with a very small pressure pattern. We break out, and then that's where the market rolls over and really continues the downtrend. Here's another example. We have a trend change where the market goes from downtrend to uptrend. Here we have the fake out component where the market takes out a previous low and immediately shoots back higher. Here's where the market breaks into a new higher high. Some traders will refer to this as a change of character. On the way up, the market leaves a few demand areas. Here we have the lowest demand area, and here we have another one. Again, if we remind ourselves about the rules, we want to have a small consolidation, a narrow consolidation, and a strong price explosion out of the zone. We can add our volume profile, and what we see is that on the exit out of the demand area, the volume drops off significantly. Here on the lower one, you can see the volume drop off is not as strong. That's not a great sign typically for a good demand area. The market comes back into the higher demand area, and we go to a lower time frame now. Here we want to analyze the trend structure. We can look at the swing highs and lows, and when the market breaks above this also now looks like an inverse head and shoulder. The market breaks above it, and then you can see the market turns over and continues the uptrend. Another example. The market is here in a strong downtrend. We broke out of this small consolidation with a strong move. Here we leave the supply area. We add the volume profile, and we can see there's a significant drop off. This is the highest point in the volume, and then you can see on the breakout here, that's where the volume drops off significantly. The market comes back to the supply area. We go to a lower time frame once again. We want to analyze the price structure. What we can see interestingly is here that we have an inverse head and shoulder, the left shoulder and the head here. We have the breakout, so this is the trigger of the inverse head and shoulder, and something that a lot of professional traders also trade are failed patterns. So what you see is that when the breakout occurs and the pattern, the inverse head and shoulder, fails, so the market comes back below that, that's your first indication that the market is not as strong as the pattern may suggest and as the trend may suggest. We typically want to wait for the price to make a lower low point here, which happens here just shortly afterwards with a strong breakout candle. You can see how strong this move is away from the fake out and now into fresh lows. We move into the first area. We test the previous support once again. The market makes a little bit of a bounce, doesn't even come close to the previous point here, and then continues the downtrend. Now let's talk about trend lines and especially trend line strategies. And here I have 13 trend line trading do's and don'ts. The first most important part, because it helps us identify valid swing points and valid trend lines, is that every confirmed trend line needs to have 3 touch points. 2 is not enough. You can always connect any 2 random points using a diagonal trend line on your charts. Only if the third one lines up, you have a valid trend line. Another important point is that we always want to trade away from the trend line. So in an uptrend, we want to connect the swing lows. That's really important. In an uptrend, you want to go long, and you want to go long at the optimal price, which is the lowest possible price. So on a trend line, we connect the swing lows and we wait for the market to come back here. We can then use this in a multi-time frame approach where we go to a lower time frame when we can see the market is hitting the trend line. It is okay to cut through the candlestick wicks, but we don't want to cut through the candlestick bodies. That's not okay when it comes to drawing trend lines. Something very helpful when it comes to using trend lines is that we need to watch the angle of a trend line. In the initial part of the trend, the angle was very steep. The market rose over a short period of time. And then when we look at the second trend line, the angle is much weaker and much shallower. This shows us clearly that the price is not accelerating as fast here. We can also see that the swing points are much wider, which means that there's more volatility. That's typically not a good sign that you want to see in a strong uptrending market. So that tells us that the market is getting weaker here on the shallow trend line. It's also really helpful to compare the different trend waves in a trend. Here we can see in a downtrend, we see that the price is falling very fast. That's a very strong bearish phase. Then here in the next part, the price is rising very slowly. So we have strong selling and weak buying. And that typically then leads to more strong selling on the breakout out of this next trend line. We can use this concept to understand trends and to time our trend continuations. You want to go with the trend, you want to go when the market is moving the fastest. So you want to stay out of slow consolidations, and you want to find a tipping point where the market goes from sideways to trend continuation. Another important thing is that we want to look for takeoffs away from the trend line. Whereas previously here in this uptrend, the market stayed very close to the trend line. but then the price accelerated and shot really far away from the trend line. That often shows an unsustainable trading behavior and price behavior. Very often you can then see when the price is coming back to the trend line the next time after this takeoff, there has been a lot of profit taking and the buyers were not able to continue to push the price higher. Here we go over in the sideways period. The clear uptrend here previously is over now. We can also use trend lines here to analyze the buildup. We're in a downtrend, the market is in a consolidation here, and when we just look at the highs, what we can see, they're moving lower. And especially, how is the market bouncing higher? In a downtrend, we want to find out when are the buyers giving up. Here we have a strong buying push, another strong buying push, and here a weak buying push. The buying interest seems now to be completely absorbed by the markets, and there are only sellers left. The tipping point is here when the market breaks out below lows and continues the downside. The break and retest is another very important concept when it comes to using trend lines. Here we have a support trend line. The market eventually breaks the trend line, and what you will often see is that the market then uses this trend line as resistance. And this we have seen when it comes to using horizontal support and resistance levels, and this concept also applies sometimes to using trend lines. Here we can see that the market flip-flops between using the trend line as support, we have the break and the retest here as resistance, we break the trend line once again, and then it turns into support once again. So sometimes you might think that a trend line is not working anymore, but it often pays off to keep the trend line on the charts for a little longer to see if the market on the next occurrence is using the trend line once again. Trend lines are obviously super powerful when it comes also to use them for identifying trend patterns. Here we have a trend line that first was used as support, it became resistance here. And we are in a downtrend, we have a double bottom, and the trend line really nicely helps us to find the tipping point. We connect the resistance areas, and when this trend line is broken, that's then where the trend rolls over and starts a new uptrend. Here we have the pressure pattern, a very narrow consolidation just before the breakout. We have seen this before. We have strong selling here, another period of strong selling here, and then when the trend line is hit the final time, the selling is very minimal. There's almost no movement away from the trend line. This shows us once again that there are not a lot of sellers left and the buyers are taking over more and more. The buyers are absorbing all of the selling until there are no more sellers left, and then what has to happen is that the price moves higher. Here the trend lines help us to define and identify contraction once again. We use the trend line here at the top and we have a trend line at the bottom. The market is moving sideways, but it's moving sideways in a very important and interesting way, especially when we look at the lows. The first sell-off was very strong away from the resistance. The second sell-off was still strong but less so. The third sell-off was much weaker and the market is then immediately back at the resistance. The time between the touch points on the resistance is also important. Whereas from here to here, it took the market quite a while to get back to the support level and the resistance level. From here to here, the time was much shorter. And then from here to here, the distance between the swings is becoming so small and the price is returning sooner and sooner to the zone. This shows us that there's a lot of pressure building. And the pressure is often released with strong momentum, as we can clearly see here. We can put the different concepts also together, obviously. We have the strong rising, so we would have a very strong and steep trend line here. The contraction here, we have the market moving into this corridor, a wedge that some traders may call it. Can also be a triangle pattern, doesn't matter what you call it. We have a fake out here, and then you can see we have the acceleration to the upside. So all of the concepts that you're learning in price action trading, support and resistance, supply and demand, and trend analysis, they can often be combined in very meaningful ways. The more confluence factors you can find in a trade idea, typically the better it is. We will get back to the video in a moment, but I want to show you my new trading program where I've packed my 16 years of trading experience in just a few hours. In the trading program, you'll get a brand new trading course with over 80 videos, and I've included ready-to-use trading strategies with rules for entries and exits. You'll learn about risk management, psychology, and so much more. There's also mentoring included, and you can reach out to me 7 days a week in our private community. I'm always there to help, and if you have any questions about your trading, you want to get my advice on a chart, you can reach out to me and you will always be able to interact with me directly. There are regular live webinars taking place, and you will become part of a lively community with traders from all around the world. We have had great feedback from our community and from our users, and the Tradecademy is the program I wish I had when I started trading 16 years ago. I am your mentor. I'm not using other teachers, I'm not using other mentors. You're always interacting with me directly, and you can reach out to me 7 days a week. The program works for day trading, swing trading, and basically all the time frames. Make sure to check the link in the video description to find out more about the Tradecademy. There's also a discount code waiting, so if you want to join now, use the discount code provided in the link and you will be able to save on your subscription. I look forward to welcoming you in our Tradecademy. And now back to the video. Now I want to show you my top 7 trading tools, my top 7 signals, indicators, price action signals that I use every single day. First, it's the daily high-low. In TradingView, you just type in daily high and then this one comes up. The creator is Unknown Unicorn. Thank you for creating this indicator. The indicator plots this channel on your chart, so it shows the previous day high and it shows the previous day low. This is a very important price level when it comes to trend trading. In an uptrend, you will see the price pushes into only the daily highs. The market fails to reach the daily lows. When this shifts and the market is suddenly moving into the daily lows and trading below them, that's a very important shift in market and trend sentiment. The downtrend unfolds, failing to reach the daily highs and only continuing to push into daily lows. It changes once again here. The market pushes outside of the daily highs, continues this weak uptrend. We could also use our previous knowledge about trend lines, right? We would connect the lows here, and what we would see is that we have strong selling, weak buying. We have a double top here, the market rolls over into the downtrend, touching the daily low, and then the downtrend continues here to the downside. We can use this in a trading strategy to trade the daily high-low breakout. In a downtrend, what you see is, as I said, that the market is breaking into new lows. And when you see very weak rejections of a daily high, that can often show you signs of a continuation. So the market pushes into the daily high here. We have a double or a triple top even, and the price is immediately rejecting the daily highs, continuing to downtrend. This can often be a great signal when it comes to trend continuations. You really have to see that the market is quickly rejecting the daily highs and turning back lower. You want to see a momentum away from it. You can stack multiple confluence factors such as trend lines here, support and resistance, and other patterns that you look for. Here the market is then going into an accumulation. The market is not able to push into daily lows anymore, and the market is rejecting the daily highs. When you see a breakout out of the accumulation, especially here with a tendency of higher lows, that can often be a sign of the market rolling over. The market broke out of the daily highs, we push higher into daily lows, and the market is trading outside of the daily high for quite a while here during this trading day. On the next day, we first have a pushback, and then the market is back immediately at the daily high. That's often a sign of a continuation. And you can see there was a small consolidation, not very strong. But then on the next day, what happens? The market trades in a very small corridor. This is what we call a contraction. The market is building pressure. The market is not pulling away at all from the daily highs, and the market is closing and trading very, very strongly. Here we have the next breakout above the previous highs of yesterday. The market breaks out here, continues higher. That happened here. We have a pushback to the downside. This is where you have a fair value gap and a supply area. We learned about this in the beginning of the video. We have here a resistance area that is presented. The market pushes into the daily low and immediately rejects the daily low. At first there was a very strong red candle, but the momentum immediately dies off and the candles are getting smaller and smaller until the price accelerates away to the upside. That's a really strong signal that the market is not ready to completely go bearish, and the bulls are still very strong here. Bulls probably just waited for an opportunity to load up on their long ideas and their long trades for a better entry price. And after that, you can see the market continued higher. So observing how the market trades around the daily high is really important and can help you with your trend trading. Next, let's talk about central pivot points. In TradingView, you just search for pivot point, and then this is the one I use, pivot point standard. Open the settings and you can change it to the time frame of weekly or daily if you're on a lower time frame. And I only leave the central pivot point on. This is the P1. I turn off all the other pivot lines. And then you are left with this blue line. This is the central weekly pivot point. As long as the central weekly pivot point is up and moving higher, you are in a confirmed uptrend. And when this changes, when the pivots are not going up anymore and the distance between the pivots is going lower and smaller, you can often see a trend change. So here we go from higher pivots to lower pivots. This changes once again here and the market rolls over. Let's see how we can use this in a pivot point continuation context. Here the market is more or less in a sideways range. We have a great trend line. What we can see here is also a contraction. The market is making higher lows and it's trading in a very small corridor. The market is also very nicely retesting the pivot point here. On the breakout, the market moves higher and continues the uptrend. Now we have significantly higher pivot points and the price is staying above the pivot point. That's a really important bullish signal. We break out higher, which is a good confirmation signal. The market continues the uptrend, the pivots continue to move higher, the market now retests the pivot once again as support now, we accelerate away from the pivot point, and then the trend continues. The pivot points are moving higher and higher. Here the distance between the pivot point from here to here and then from here to here ultimately is becoming very, very small. That shows us clearly that the market is slowing down. We can see that, and it's a confirmation that the uptrend is likely to be over. Now the price rolls over, and now the market is not only trading below the pivot point, but it's retesting the pivot point now from underneath as resistance. That's an important signal that the bears are now gaining control. The pivot points now fully roll over, we have lower pivot points, and the market is in a downtrend. If you're a price action trader, you just must know about divergences. What is a divergence? A divergence is when your indicator and your price action are not agreeing. This is the 14-period RSI. You can use divergences on any time frame. And what you can see is that the RSI is making lower highs, but the price action is making higher highs. What is it telling us? It tells us that the price action is getting weaker. We can also see that by just looking at the price action. Here was a very strong bullish push. The next bullish push is much weaker. Here we only have one green candle that advances the price just slightly higher. And then from here to here, the first important thing to note is that it takes the price quite a long time to go from here to here. The high is also just a little bit higher, and we don't have a strong push. This is what is causing the RSI to make lower highs. So you might not even need to have the RSI if you know exactly what the RSI is telling you. And if you're able to read the momentum and the price strength, that can already be enough to help you understand that the price is slowing down. Here we have a bullish divergence. The market is in a downtrend, the market is making lower lows, but the indicator is making higher lows. The initial strong downtrending push that we have seen here is losing momentum, and you can see the price is moving lower, but only very little. And the pushes into the new lows are getting weaker. A divergence is therefore a sign of the trend weakness, and it can often help us to understand when a trend is likely to be over and rolling over into a new trend. Next, I want to show you moving average channels. Everybody knows about moving averages, but channels are often not so much talked about. You want to add two moving averages to your chart. The first has a length of 30 and the source is high. The second, same length, but the source is low. This gives you this channel here on your charts. This is the moving average channel. In a trending market, you will often see that the channel first of all is moving higher and the price trades above the channel. When the price is falling below the channel and the channel is starting to point sideways and down, that's often a sign for a trend change. We can use other concepts like our trend lines that we've talked in the past. We are going here from a sideways consolidation where we have weak buying, and then we continue with strong selling, strong breakout. The market is retesting the channel. It's trading below the channel, and you could, for example, use the moving average channel to trail your stop loss as well. The moving average channel helps you to lock in your profits and your stop loss along the way. I love using the Fibonacci tool. In TradingView, you find it here and then use the Fibonacci retracement. Those are my settings. You can copy them and use them in your own TradingView as well. Fibonacci targets are used in trending markets. What you do is that you draw and drag your Fibonacci from the high point to the end point of the first trend wave. Then the Fibonacci retracement gives you retracement levels. Here you can very nicely see that the Fibonacci retracement and the price action snap at the 50% Fibonacci level. Often in the trend continuation, you see that the price is moving into the 161 Fibonacci extension target. Rarely you will see that the market is moving into 200. Only very strong trends move into 200. Here another examples. We drag our Fibonacci from here, the beginning of the uptrend, to the end point of the first trend wave. The Fibonacci retracement shows us that the price is respecting 61.8, and then on the continuation you see first a push into 161 and then 200. In the beginning you probably want to stick to using 161 or maybe even just 150 to be on the safer side when it comes to using targets. Seeing the price reach 200 is not super common and it requires a really strong trend, and that doesn't happen too often. Bollinger Bands are another great tool. In TradingView you just open your Bollinger Bands, and when you trade them on the lower time frame, for example the 1 hour, what I like to do is that I change the time frame to 4 hour. So this gives us the higher time frame Bollinger Band on the lower time frame. So here we are even on a 30-minute, and those are the 4-hour Bollinger Bands. And what you can often see is that when the price reaches the outer Bollinger Band, often there's an exhaustion. Of course we need a little bit more confirmation here. For example, we see that the market is making lower highs, breaking this swing point, breaking and retesting this. Here is also a very important order block. Then the market continues lower. Another important signal is the Bollinger Band contraction. Here on the left, you can see that the Bollinger Bands are very, very narrow. This shows us that the market is in a tight consolidation. On the breakout, you can see the market is moving outside of the Bollinger Band. And when the price is able to trade outside of the Bollinger Band, that's a sign of a very strong trending market. So you don't want to fight your Bollinger Bands when the price is outside of it. There's also no sign of exhaustion. Compared to the first example, here we clearly have a sign of exhaustion with lower highs and then the breakout. Here we just see the market strongly trending outside of the Bollinger Bands. I once had lunch with a hedge fund trader, and what he said is that he only trades Bollinger Band spikes. We use the 4-hour Bollinger Bands and then we use them on the lower time frame. What you want to see is that the price is rejecting the lower Bollinger Bands. Here we are in a strong trending market. The price just trades outside of the Bollinger Band, keeps making higher highs and higher lows. And we don't want to go against this. This is a strong trending market. On the opposite side, the market moves into the lower bands. It's rejecting the lower bands and shooting higher. So that's exactly what you want to look for. The market attempts to move into the lower bands and then is immediately rejected higher. Then on the next time on the opposite side, we see more rejection and we see another weakness point. The market is failing to make a double top, is failing to trade higher. So that's a sign of weakness. And you can see we are seeing strong bearish momentum as soon as the market reaches the outer Bollinger Bands. This is where the rejection happened. The market trades lower. It trades outside of the Bollinger Bands. It's in a strong downtrend. No sign of exhaustion. So we had our first rejection signal here and then the next rejection signal here.